So we have a huge correction today in the precious metals sector. Silver's down over 8%, gold down 7%, platinum around 8% as of this recording. And so you have to ask yourself, is this some kind of watershed moment in precious metals? Or to just let your phones ring? You want to understand why people are pining for an alternative to the US dollar, and they're running into this like crazy stuff like Bitcoin. But in reality, what they need is gold and silver and platinum. And that's what's happening. So that's why I think, again, as of now, it's just a healthy pullback in the precious metals complex, which if you have the courage to step in when silver's down 8%, you might be rewarded a few weeks from now.
In today's news recap, silver price slips below $47 due to optimism over U.S.-China trade deal. Silver price remains subdued for the third successive session, trading around $46.80 per troy ounce during the Asian hours on Tuesday. The price of the safe haven silver declined 3.78% in the previous session amid risk on sentiment driven by the optimism over the U.S.-China trade negotiations. Senior officials from the U.S. and China announced over the weekend in Malaysia that they had reached a framework agreement on tariffs and other major issues, setting the stage for Presidents Trump and Xi to finalize the deal during their meeting later this week in South Korea. U.S. Treasury Secretary Scott Bessent said that President Trump's threat to impose 100% tariffs on Chinese goods is effectively off the table. Bessent added that China has agreed to make substantial soybean purchases and to postpone its rare earth export controls for a year while they re-examine it. However, the downside of the gray metal could be limited due to the increased likelihood of a rate cut by the U.S. Federal Reserve. Fed on Wednesday. The Fed is widely expected to lower interest rates by another 25 basis points, bringing the benchmark rate to 3.75 to 4% at its October meeting. The CME FedWatch tool indicates that markets are now pricing in nearly a 97% chance of a Fed rate cut in October and a 95% possibility of another reduction in December. Moreover, market sentiment may turn cautious as the U.S. government shutdown has ignited debate among Federal Reserve officials as policymakers weigh whether to cut rates soon to support a weakening labor market or maintain current levels amid inflation that remains persistently above the Fed's 2% target. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
You have to evaluate, is this a trench-in watershed moment, an epiphany in the precious metals market? Is the bull market over, or is it just a healthy pullback? And nobody knows for sure at this moment. God only knows, and I'm certainly not him. But I will tell you this, what has really changed? And the answer is nothing. We had a secular bull market in precious metals that went vertical. It just went linear. And in my opinion, at this juncture, this moment, it's a healthy, necessary pullback in the bull market of precious metals. Because look, I mean, here's the facts. The Fed is panicking now. They're actually in panic mode. They're not panicking to raise interest rates. They're now going to actually accelerate the monetary debasement of the dollar because they're cutting interest rates. They're going to cut again next week, second time. This is before the new chair comes in May of 2026, who's going to cut rates even more aggressively. The Fed is ending quantitative tightening. As a matter of fact, I checked yesterday. I looked at the Fed's balance sheet. Quantitative tightening means you're actually shedding assets, so you're draining the balance sheet. The opposite is, since October 1st, the Fed's balance sheet has been increasing. So they're already in the process of quantitative easing, and I think that accelerates under the new Fed chair. It coming in 26. And then is China now selling gold to stockpile treasuries? Is Russia doing that? So, I mean, so there's nothing really changed. Has the United States paid off its debt or deficits? The deficit this year is the same as it was last year, despite all the revenue that we're taking in tariffs. It's the same number, $1.8 trillion. That's not my opinion. That's a fact. So from the Congressional Budget Office. So deficits are still dangerously high. Debt is over the top. We're monetizing debt at a faster rate. So until one of those things changes, then I will say, well, maybe this is the end of the bull market in precious metals. As of right now, it's just a necessary sell-off that should be bought. Now, if it continues to erode, you're going to break some support here, and it might last longer. It might be a significant pullback. But at this moment, it's a very healthy correction.
In today's news recap, gold sinks below $4,000 as investors sell safe haven assets on China-U.S. trade deal. Gold prices fell below the $4,000 level on Monday as investors moved away from the safe haven asset on prospects of a U.S.-China trade deal. Spot gold dropped to just below $3,980 per troy ounce, while futures for December delivery fell over 3% to dip below $4,000 at one point. The developments came as U.S. and Chinese officials signaled a likely breakthrough in the trade standoff ahead of President Trump and Chinese leader Xi Jinping's meeting this week. Futures for the precious metal have been holding above $4,000 after suffering the biggest daily drop in more than a decade last Tuesday. Last week's decline halted the biggest year-to-date rally in gold in more than 40 years, snapping a 9-week winning streak. Since 1975, there have been 16 other similar reversals, and while some of them did represent short or long-term peaks in gold's price, there were also plenty of others that occurred within longer-term uptrends. Bespoke Investment Group wrote in a note on Monday. So while gold definitely lost some of its luster last week, there's still the potential that it only needs some polish. So I guess when we said last week that taking some chips off the table after a mega rally to buy back lower wasn't such a bad idea, that commentary aged pretty well, right? Now smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
Well, I mean, I don't have a number for you. I just know it's much higher than the hedonically and substitutionally adjusted. I mean, who cares? Does anybody invest looking at the CPI? I look at the rate of change of things. Actually, the second derivative is the most important thing to me. So it's the rate of change or the rate of change. And for me, it means that inflation is heading higher at a faster rate. So we were growing at 2.7% year over year. Now this next print, whenever we get it, because the government's closed, but we're going to get a print on Friday. And I think it's going to be 3.1%. That's higher than 2.7. So the rate of change is accelerating. And yet we see the Fed, for some unknown reason, is anxious and now panicked to cut interest rates, end QT, and re-enter QE. Even though we spent 4.5 years above their silly, ridiculous, derisive target of 2%, and we're 50% above 2%, heading further away from 2%, and they're cutting interest rates. You won't hear this from the financial media. The reverse repo facility. This is basically the excess reserves from banks that they didn't need and they parked it at the Fed. And that was used to buy treasuries to make sure we had quiescence in our bond market, even though we're an insolvent nation. That was $2.5 trillion in 2022. Well, today it's effectively zero. So the Fed knows that all of that excess liquidity that the banks had parked at the Fed is now gone. So they don't want another repo crisis like they had in 2019. We're on the the threshold, the doorstep of another one. So they're preemptively, obviating the need for that aggressive rate cutting and to, spike the balance sheet by $1 trillion. They're trying to get ahead of that by now ending QT, lowering interest rates, and rebuilding the balance sheet. It's funny that the balance sheet was $700 billion prior to the global financial crisis. It spiked to $9 trillion. They managed to get it down all the way to $6.3 trillion. From $700 billion to $6.3 trillion. And the reserves in the system were almost negligible, almost zero. And they spiked to more. As a matter of fact, I'm going to put on my web, as part of my midweek reality check this week. I'm going to put a chart up of reserves in the financial system and showed how they spiked from like zero to over $3 trillion since the global financial crisis, and then really went ballistic after COVID. And there's still, a superfluous amount of reserves in the system, and yet they're adding those reserves. So you want to understand why people are pining for an alternative to the US dollar, and they're running into this like crazy stuff like Bitcoin. But in reality, what they need is gold and silver and platinum. And that's what's happening. So that's why I think, again, as of now, it's just a healthy pullback in the precious metals complex, which if you have the courage to step in when silver's down 8%, you might be rewarded a few weeks.
What do you think of Pento's take? Do you agree with him? Is this just a healthy correction, or is the bull market over for gold and silver? Post in the comment section down below if you're buying more and taking advantage of this dip, or if you're panic selling all your stack to the first dealer who buys it from you. Now, watch this video right here because it's a perfect fit for you, and I'll see you on the other side.